there's kind of this feeling that like, how can the party get any better, right? We've all been there. Maybe you're in high school and had to run from the cops at the end. Maybe it was a college fraternity party. I don't know, but we've all been at a party. It may have been one where your wife said the wrong thing at the last minute, and you should have left 5 minutes ago, or you should have. Yeah. We've all been in those situations where it's just too good, and you should have left an hour or 5 minutes ago. There's a reality to that, and that happens a lot when you cover businesses for 20 years like I have, and we do as a firm. You see it all the time where it's pretty good, and somebody starts playing for that last penny or 2 pennies, and you're like, I don't know, man. You're one of the first to exit, and there's only 10 of you, and once 1 or 2 of you move, the consolidation is going to happen in the last 3 or 4. The pricing power is going to switch to the buyer.
Hey there, it's Mike Langford. Welcome to another episode of the 6x6 Lock Podcast, a secure money movement podcast for the private markets. On this episode of the show, Todd Sorrel and I are joined by Robert Koven, co-CEO and managing director at JEGI Leonis, one of the country's leading middle market technology M&A advisory firms. This is a fantastic conversation for anyone in the private markets who wants to know when it's the right time to exit their business, how to find the right partner, and what AI is doing to deal valuations right now. You're absolutely going to love this conversation. Now, before we get into it with Robert, please do make sure you subscribe to the 6x6 Lock Podcast on Apple Podcasts, Spotify, Amazon, the YouTubes, or wherever you like to get your podcast jam on. And if you have a question or a suggestion for a topic or a guest, hit me up. I'm basically at Mike Langford everywhere, or you can shoot us an email, podcast@6lock.com. Okay, let's get to the conversation with Robert Koven. Well, Todd Sorrel, Robert Koven, welcome to the 6x6 Lock Podcast. So wonderful to see you guys.
You too.
Good to see you.
Good to be here, brother.
Man. This is awesome. This is fantastic. I'm super pumped about this one. And I got to tell you, I kind of feel like the guy, was like hanging out with dudes, who know each other. You ever go out for drinks and like the 2 guys you're going to hang out with, like each of them have a good history with each other. And like, you're kind of like new to the crowd. You're like, this is going to be a really fun time, but it's going to take me a while to catch up because you guys actually do have history with each other. Yeah. Todd, you mentioned that you hired Robert to sell your last company, and knowing you, that's something you didn't take lightly. So like, why don't we jump off there? Like, talk about that experience a little bit, like how you guys came to know each other, and that'll kind of be a good way to set the stage for today's show.
Yeah, right on. Yeah, I mean, you're right. You're kind of outnumbered here. We, Robert and I have a few things cooked up for you, Mike. So, we'll just prepare yourself. All kidding aside.
We'll do shots later.
Right.
Do those in the show or after the show?
Yeah, that's right. You're in good company. Look, EP policy was on a massive growth trajectory. I think our rule of 40 was double or even triple that, just kind of the compounded exponential growth we were receiving. We were experiencing as a company. We couldn't even hire fast enough. And we learned a lot by doing that, hiring very quickly and doing all of that. But I think we hit this inflection point at one point. It was like, Mill and I were looking at each other and going, I think we can grow. I think we can grow even faster. We are first movers in a space. We have a lot of traction here. It feels like greenfield. It even feels like a little bit of TAM expansion here, which is kind of weird. Like TAM expansion it usually goes the other way as companies grow. There's a little bit of contraction because you hone in on certain ICPs or areas of the markets or segmentation of it, I guess. And for us, we were just kind of going the other way with it. We were adding retail, we were adding wholesale, we were adding premium finance, these other segments of insurance. It was this TAM expansion. And so we kind of looked at each other and said, hey, what about bringing on a partner one day? And what would that look like? And who should that be? And let's write out a top 20 list of all the things that we would love to see with a sponsor type partner, really to kind of get a growth engine in this thing really going for it. Someone that understands, InsurTech, someone that gets founder-led companies. I don't think all of them are friendly to founders, frankly, in my experience, but I think that was one of our, probably top 3 things was really friendly with founders. They understand because founders obviously know the story, the history, where the bodies are buried, and they could tell the story well. It's definitely, the right founders, of course, really can certainly, lean into those growth and those those new game plans coming in and just be vulnerable and open a little bit to like, hey, we're going to accept this. Let's go do this. So it was actually weird. We had an inbound call by Foxy, and he works with Robert Koven, and just a fantastic person. I've gotten to know him over the years, and just a solid dude. And he reached out to us. He was very persistent. I kept on telling him I wasn't sure yet. I don't want to talk to him. And it sounds like you're from New York and I'm in Texas. Let's be honest. And he was super cool. He's like, hey, I'm going to be in town. I was like, dude, well, come see us then, man. Let's go get some barbecue and let's hang out a little bit. And he did. He did what he said he was going to do. And I think and I just want to say that's a theme here throughout doing business with Robert and his team is they just did what they said they were going to do. Right. And I think that a lot of people, a lot of companies don't do that, but they did it, and they did it with exceeding expectations for us, and it was just a fantastic experience for us. I felt like they were in our corner. We had a lot of things that we wanted to achieve going through a deal, and they were sensitive to that, and they knew we were kind of on the younger side of things. I mean, we were kind of hitting a space where we were probably on the lower. We had a lot of no's just because we were just kind of young and lower on the revenue scale of things as you look at the market in a broad swath. And we were just kind of coached through that. I think there was just a lot of coaching, a lot of understanding, us really getting our heads around the market. We still wanted to go through with the deal and bring on a sponsor. But yeah, Robert was leading the way for us. And he actually came down from New York to see us in Austin as well at some point. And yeah, I'll let him tell his side of the story. It may be different from mine, but no, it was, yeah, we look, it was just a great relationship, and I think we hit it off, and we were aligned. You know, we were aligned pretty early on, the way we see the world, the way we handle things, the way we do business.
Yeah, I think we were lucky in that capacity, you know, both in terms of just a very similar view of the world and the space, you know, and they had built what is and was a great business at the time. That was unique when we looked at the growth prospects of it. When we looked at the TAM, you know, not a lot of businesses will fit that type of description, you know, both in terms of the KPIs it's exhibiting, but also the ability to kind of continue to replicate that year over year. So there's a lot that we were excited about, and obviously a lot of what we do is on the road, right? So, you know, Texas these days, and even back then, you know, Austin specifically is still an area that we're heavily active in and are there quite frequently given the tech scene. So yeah, definitely part of the fun and the travel of what we do every day. And obviously, you know, Todd and Millen were, you know, great entrepreneurs at the time and had found a place where, you know, there was just a need, you know, and we see that often, you know, with companies. There's natural scale points for businesses. And oftentimes to grow and continue the growth, you know, there needs to be other folks that can pull as a partner that aren't just capital providers. There are times where just providing capital may make sense. But in situations where you're running into, you know, growth or hyper growth, you know, often that right partner plus the capital can be quite game changing as it relates to the next phase of the business's existence. And I think they were a very, you know, direct example of that. And you can look at even how the business grew subsequent to that investment, and it's a pretty good proof point.
So do you do a lot of business in Texas? You mentioned you guys have been doing a lot. How did that come about? Right? Do you have any special connection to Texas, or is it just like you started seeing one opportunity led to another?
I think one leads to another. I mean, you know, and I would say there's certain towns in the U.S. where we've had that. We've had in Atlanta. We've had in other places. You know, geographically. You know, we have folks that sit in certain cities, right? We've got guys that sit in London and Boston and San Fran. You know, some of the large tech hubs. You know, and from that standpoint, a lot of our coverage is verticalized in terms of what we cover, but there's pockets, you know, fintech and payments. Atlanta's a great example where, you know, we spend a lot of time because there's a lot of that there. And one deal often begets the next. You get a lot of specification around what's going on in the market that's very transposable and relevant to other folks playing and building in that market. And so for us, Austin is a prime example of that. We've probably been, you know, through 6-8 deals there in the last, you know, 5 or 6 years.
Oh, wow.
Yeah, so it's definitely a key place, and I mean I was down there last week. You know, I actually tried to get Todd to meet me last week.
I didn't see any invite for to grab beers with me. This is like the whole thing I said. I was new to the group.
We already cut you out, Mike.
I could have been having beers with Robert while I was here in Austin, even though Todd wasn't available. It could have just been us hanging out. And it would have, you know, had we had more hangout time leading up to that. I'm sure.
I like being that. I still have a little leftover, you know, Southern accent being from the Southeast. But,
awesome.
No, so Robert's he's an Atlanta guy. Although I mean, most of would you say like how many years are you in New York now? It's almost, is it
I,
out
yeah, I
wedding?
know. I get that question a lot. I'm equally
Yeah.
distributed now, so
Yeah.
now I don't know what country I belong in.
Right.
I'm kind of the same thing. I jokingly say it's like the old country. You know, I grew up in the Boston area. Both my kids were born up there, but we moved here 15 years ago to Austin, and so it's kind of like thinking about the old country, like the Irish immigrants in there, because it's like I'm still a raging fan of the Celtics and Red Sox and all my Boston teams. So I feel like a dude in a different country, and I just. But both my kids kind of feel like, well, I grew up here. You know what I mean? They're more rooted in Austin. So it's just a weird experience, right?
Yeah.
So let's talk a little bit about JEGI, or do you call it JEGI? How do we want to pronounce it here?
Yeah, I wish I knew. JEGI Leonis, JEGI Leonis. We could go by both. You know, the composite of a merger over the years.
Yeah.
But you know, definitely from a name standpoint, you know,
Yeah.
we don't care as long as people know us.
So let's talk a little bit about it, because it's really interesting. You don't often meet somebody in your space who actually is also an entrepreneur, who's also started a business, right? And
Sure.
Typically, you know, people in the investment banking world are, you know, they just came up through the banking world, right? And that's what they do. And you came up through the banking world as well. You were with JPMorgan, Lehman Brothers, you know, and the like. But what was it in the world, in the market, that you're like, you know what? I got my own vision. This is what needs to exist. Let's make it happen.
Yeah. Yeah, I think we you know, when I look back, you know, and at the time was leaving, you know, Lazard in that era, where a lot of workout had been done, you know, in the financial services side, fixing balance sheets, divesting non-core assets, you know, what we'd call today paytech or insurtech, you know, were non-core assets being divested by those groups to right-size balance sheets, whether it was AIG or the Lehman estate. And so as a young kind of mid-level banker, I got a lot of exposure to that ecosystem. You know, as we were coming into a better era, you know, out through kind of that last great recession, into that, you know, 11, 12, you know, 13 type of time frame, you know, you can see the beginning of what today we'd call kind of fintech, insurtech, paytech, all these, you know, techs. And as it was, you know, kind of evolving, what we saw was it was also a lot of new technology being started by folks, you know, that in 2 to 4 or 5 years could be very nice businesses, and not necessarily venture backed, right? You know, a lot of bootstrapped work where folks were, you know, trying to bet on themselves and working very incrementally, not your Sandhill Road per se. And when we looked at kind of those folks and where that ecosystem was going and where the private equity money and the capital markets were moving, they were moving towards each other. And we had a viewpoint early on of there isn't going to be enough representation of that mid-market, lower mid-market, you know, group who's just had 3 to 5 years of building and suddenly is running into the capital markets that are oftentimes, you know, coming down from upmarket, right? And if you, I mean, examples of this, you know, think of Excel KKR. AKKR was a joint venture of Excel and KKR. That was a creation of a growth category investor. Over time, you saw there's, you know, Sarant, Mainsail, others we could name on this show, but start to flow into that. It became a real asset. And so as we could see the early formation of that going, you know, we really thought there was a business there that didn't exist that much, you know, inside the technology ecosystem for, you know, companies that fell in that kind of growth category, right, where growth and buyout meet each other. And I think that was, at the time, that was a relatively unique space and angle to be playing. And we also felt like that's where the bootstrap founding, you know, folks would be, and where there was an underserved kind of need as it related to advice to manage, you know, on the other side of the table from folks that had very tactical financial expertise as they'd come from upmarket private equity and were trained in structure and trained in the techniques of deal structuring. While they could be great partners, we didn't want to see CEOs, founders, you know, disadvantaged, you know, by the lack of knowledge that those other parties on the other side of the table might have. And so it was really with that kind of thought process that we kind of put the business together, you know, nearly a decade or so ago. And kind of one by one started working. Obviously, natural place for us to start was in fintech and insurtech areas that I'd covered, and so I started where I'd been working in that ecosystem, and, you know, insurance, you know, it was a key example, and Todd around that time.
Was that at Lehman where you were doing fintech?
I was doing most of that at Lazard.
Lazard, okay, yeah. Okay.
At the time, you know, it started out as restructuring. I think 09, 10, 11. Yeah, those were deep restructuring years in 09 and 10, especially.
Yeah. When I think about that back then, I mean, it was just a handful of fintech, right? I mean,
there wasn't much. And a lot of it was
PayPal.
built internally by these guys, and they were divesting it because they were trying to focus their balance sheet down and get the cash in to offset some of what they were dealing with from liquidity needs.
Yeah, interesting times, really coming out of GFC.
Yeah.
seeing what tech was doing to business coming out of that from a financial standpoint.
And that was really where the world of SaaS was beginning and moving from an ASP model.
Yeah.
Everything was still on-prem, and by the time we were working together, Todd, the migration to the cloud was really pretty underway.
That's right.
And so
Good point.
you think about the confluence of like 09 to 1920.
Yep.
A lot of what we think about today that's getting challenged even by AI now, but back then, was kind of the model du jour. Those were kind of things that really started out around that ecosystem in 09, 11, kind of time frame. So we were seeing that, and that was what we kind of said, hey, we could be part of that.
Yeah. Yeah. Now, that's interesting when you say cloud, that's another inflection point when you look back on history of saying, you can look at email, internet, you can look at mobile coming out when the iPhone being launched and all that. But cloud was a huge one too, leading right up into the AI boom that we've seen in the last 3 or 4 years. Lots happened the last few years, man.
Yeah, well,
you've seen a lot.
Apocalypse,
but
it's just another evolution of the story, right?
Yeah, it is. It is.
There was a time when people worried about investing in on-prem assets. How are you going to get them to the cloud? Well, they got them to the cloud.
Yeah. It happened. Yeah, my dad has a small business. He did the same thing. He had this on-prem stuff, and I kept kind of working on him, getting in his ear, and like, you need to go to the cloud one day with this. This on-prem stuff is like, here are all the reasons why it needs to move to the cloud. And look, I'm an old timer. Like tech was not friendly with him, and vice versa. So, but he ended up doing it. It was a good thing. It has to be. I mean, all of the protections and the security and the identity around like what you need in cloud today is far. You can't do that on-prem.
Yeah. It's funny, we were talking before we clicked the record button, we were talking about self-driving cars and so forth. And it's very similar to that concept. Like every once in a while you see something, it's in the early stages, but it's also really easy to go, oh yeah, 10 years from now, this is how everybody is going to do it. Like the cloud stuff, I remember the same thing you were talking about.
Yeah.
Everywhere you went, people talking, you got to be on the cloud. Same thing as people talking about mobile.
Yeah.
And if you were in those early days, it was easy to look around the room and go, yeah, probably not. Right?
Ask a healthcare provider, financial services, a government. They had a real view about, on-prem or not.
Yeah.
And then all of a sudden, no, it happens really quick. Because you know what? Those companies that were making the cloud and other stuff they're hearing the objections and they're working on it. They also understand like, hey, the infrastructure is still being built. So the thing that you're saying is really frustrating, whether it's a broadband internet, being able to access the cloud enough from wherever you are, or whatever, ubiquity of mobile, right? Those things are coming, right? It can be faster than you think it is. Anyway, so let's talk a little bit about some things that maybe our audience isn't super familiar with, because I nerded out on it during our prep call, because most of our audience is, people running funds, right? Managing PE firms and so forth. And so they do work with bankers, but they don't always see the other side of the equation, the stuff that you're working on. And you mentioned that about a third of your business comes from reactivity, as you described it, and about 2/3 is this long game coverage effort. And we kind of just talking a little bit about it here. Companies that you met a while back or whatever, or areas you started focusing on, and the next thing you know, you're starting to see the things bubble up, going from 8 people to, oh wow, this company has 50 people now. So walk us through the kind of the day to day. Like how does a company end up in front of the right buyer? Like how do you manage that process, if you will?
Yeah, so we spend a lot of time covering, and we'll often cover businesses very early and get to know them as they're growing, maturing. It allows us to position them better, candidly, when we get to a place where they're looking to raise capital or sell a business. One, you can definitely give the evolution story if you've been around it a lot more intricately. But two, some of the questions that naturally buyers, investors are going to ask are encapsulated in some of the decisions that were made along the growth curve as you're kind of getting there. And so the more familiarity that we have with the business, generally the better we can articulate the value prop, the go-to-market strategy, the TAM, the SOM, the SAM, all those things that are going to be diligence heavily, as you get into any of these processes. So the longer we stay in touch with folks, often the better it will be. That conversely, we get brought in about a third of the time where something is about to happen. There's an impending, letter of intent that's coming in, and they want a review of it, or in comparison to what the market might say. They may want to shop that. They may want to say, you know what, we don't want to even engage it, but we want to think about a broader thing that we never would have thought of, because now we realize that valuations in a certain range, we've been heads down, and let's explore a broader process so we get the absolute right partner because we don't want to miss. So there's catalysts, there's natural catalysts that happen just through, I think, the communication channels of the buyers, the investors out there interacting with the companies that then stimulate a person that's looking at that event saying, hey, this is an important part of my net worth, or this is an important asset or decision on a partner, and I haven't had a partner since I left the business to start a business. And so I don't want to get that wrong. I want to make sure we've got somebody actually, taking us through the paces to make sure, one, we're screening against folks that may not be the best partner, but two, we're spending time and really pouring in that time on the folks that can be. And so you're trying to always help the company weed out, kind of tire kicking like behavior, educational behavior versus, behavior that's very much, hey, we've been there, we've done it, we've got either networks that are very applicable, we've got prior experience that's heavily, kind of predictable in terms of what we can effectuate with you guys. And that can be in the form of M&A, it can be in the form of go-to-market, it can be, a whole host of things, pricing, et cetera, that often come with capital, and that when people think about capital being, quote, commoditized, that part of the equation's not, right? And that's the operational leverage you might get from a partner. Now, some people want that and others just want to be left alone. And there's groups that want to come in and invest and be very passive as well. So having somebody that can kind of guide you through all that and really kind of weed out the stuff that doesn't fit what you want as the owner, the manager, et cetera, it can be pretty powerful. And so often part of what we're trying to get to know when we learn and meet people early is, what are they building for? Are they building just to build? There are guys out there that just want to see how big they can build it, and it's just fun. And they've made money before, and they have no intent to ever exit the business. Okay. But they may need capital along the way. Yeah. You have other guys that say, no, I'm going to build this for 5 years. Kids will be out of college. It'll be a year or two past. Like, I'm happy to transition it, but then I actually, want to be ready to see my grandkids. We have that pattern too. Or, hey, I'm 34 years old. I've never taken a payday. It'd be nice to know I actually own my home and have, college tucked away for the kids. Let me de-risk some part of the business and keep throwing for the fence. So we run into all those patterns, and understanding that also informs the right type of investor, the right type of strategic process. And so getting to actually know the human being behind it, not just the business, often is as important as just getting to know the business. And so the longer we know people, the more effectuating we can be as it comes to getting the right outcome.
It's interesting. Todd, you've been through the sales we talked about at the beginning, right? So from your side, on the other side of the equation, what's kind of surprised you about like how this process works? I mean, you're an educated guy in the financial space, but like, everybody's going to have a first time selling a business, right? And what was that like?
Yeah, no, it's a curve. I think I also realized too very quickly, a couple of things come to mind. One is it's just a different type of poker than I was used to. And I say that just because there are a ton of levers, there's a ton of options. Yeah, you can go on it on your own, and you can go and sell it, take your business to market, and you can do it that way, of course, and be Lone Ranger this thing in a marketplace and try to find a suitable partner or a complete buyout, whatever you want to do on that. But I'm not sure you know what you're doing, and I would say that to any business owner out there. If your head's down and you're cranking and you know your space and you're winning and you're growing your business and the organization is expanding and you're taking market share and the product's adding features and enhancements and things are like, you don't have time to go out there and study a market and know what valuations they're paying today and whether that valuation is like aligns up with what you have. Like, there's just so many things to this where you have to, in my opinion, man, go find a partner, go work with someone who can says, I know the space, I know it really well. Let's have a conversation and really dig in on see where your company is at this point, and let's just see what those options are for you. I mean, where a company is in its life cycle kind of defines what options you have in it with it, and that's important to know. But it does. I mean, look, we quickly learned that, like, oh man, I'm a little bit of fish out of water on this deal. Let's find a great partner that knows us, that wants to dig deep, but someone who's just like high integrity is important. You want somebody who's going to do what they say they're going to do. You want someone who's just going to be like a great negotiator who can just work with folks. And, and I would say too, also in the process, there's ups and downs. You're going to lose some points, but you're going to win some points too. And I think you're going to have to weigh which points are really most important to you, But I think with the right counsel, the right banker working with you will help you really kind of weed through that pretty quickly. You're not alone on it anymore. You're really kind of working through this process, and it is a process. I mean, it can be 20 stages, it can be 10 stages to the process. But again, you don't know what you don't know. But that's why leaning in with a banker, in my opinion, was just like really important. I think we went to the market at the right time. It was kind of weird because we did it right like 2 months before COVID hit. Strangely enough, I mean, funny story. This is so true. We were out in Vegas with Robert and his team, and we were, having a ball out there celebrating. The deal was done. This was March. My wife's calling me saying, I think like they're shutting down in California. It looks like it's kind of heading this way too. I'm like, what are you talking about? What's going on? And so all of us, hustled back to how, life happened after that. But it's just looking back to just the craziness of like a December close in 2019. It was just kind of mind boggling because it was just, anyway, I digress a little bit, but back on track. I just want to say you got to have a partner in it. It's a process you probably don't understand unless, you study it and you're a student of the game, and most founders aren't.
Yeah, I'd say, Todd, like the thing I'll always say is we're a specialized tool. Anybody can use a hammer. Like there's some wrenches in the toolbox that you look at and you try to remember what they were for. That's kind of us, right? Like we'll talk to folks forever, and then suddenly we're very useful. And prior to that, it's hard to kind of think, all right, great, appreciate the market intelligence or what you're seeing, but like not today. And we get that, I mean, there's some folks we've talked to for 10 years and they finally say, hey, today's the day. And there are other folks that call you that you didn't know a week ago, but were a referral in, right? And we get everything in between. The partner side is the biggest thing I'd emphasize, especially on mid-market assets. It is rare when there's a whole team of folks that are designed. You think about the cost of just keeping in-house talent to be ready for M&A. It's not going to be cheap, and there's no reason to have it as a certain size business usually. So most of the folks we deal with, it's going to be the CEO, a CFO, and a couple other C-suite execs, pulling on a ton of data, answering a ton of questions. The more that we can go one to many on that, the better we can do in terms of getting optionality into a process. Optionality usually helps pricing and structure and all sorts of things. But the biggest thing is it's a partnership, right? And why do we as the bankers want to take as much of that load off of the folks looking for capital or selling the business? And the answer is one of the biggest inhibitors to getting a deal done is inter-period performance, while you're in market. Do you hit your numbers, or do you fall behind them? And it doesn't matter whether it's a buyer or seller market. A seller market may be more forgiving, but it's still going to raise a question. But in most processes, you're going to find that the biggest challenge is whether or not people are tracking. And if you've got the company too distracted, the process is either too long, elongated, or you've just got people overwhelmed because they're answering the same question 18 times from 5 different vendors. That's a hard thing to also do your day job with, right? And most of the guys we work with tend to not be pulling 40-hour weeks. They tend to be looking at 40 as like as a break, and 80 is like not an unusual bad week. And so we know that. So the partnership matters a lot because you've got, as much as it's important for us to do our job, it's important to let the team, the managing team, really be able to do theirs and hit on that. And especially when you're at high growth, like Todd, if you think about if you're running profitable high growth, that rule of kind of commentary that Todd was alluding to earlier, well, you're getting the growth, but it's also following through at margin. So you're getting both. And when that slows or inverts, it runs the other way, and suddenly you're not getting that growth and your margin wasn't what you thought it'd be. So it's doubling down on you. So that's, when you think of that rule of, it's kind of levered up, levered down kind of conversation. So the more that we can take off plates and make sure that holds the right way, the better it's generally going to be for our founders.
Mm-hmm. Yeah. You're like a deal Sherpa. That's the way I'm thinking of it. The guy who's been up the mountain many times, right? For the people who haven't been up the mountain, it's so important to like have that trusted, hand at the wheel, right? To be able to come in and offer guidance when necessary. Because to your point, like the thing about like in process performance, I think what you're saying, or however you describe that, it's like that's not a thing that a person normally thinks about. They're like, okay, we're working on the deal, this and that, and I'm just doing my job. And all of a sudden, they're asking me questions about how's the business doing now. It's like, well, we already started this deal process, right? So you have to be prepared to walk through that, and having a calm hand at the wheel to be able to go, hey, we've done this before. Let's walk through it. You're going to be okay. Is really important.
Yeah, it helps. I think the other thing, the private equity guys on your podcast here may not appreciate it. They like to be able to go direct. There's a reason, and we'll leave that off the side for a minute. But I think the bigger thing is when you look at how they typically sell their own assets, they're going to use a bank. They are managing their time too as private equity managers. Again, no different than a CEO managing his time over the operations of the business or the sales or wherever he's spending time. And they know there's value in that outsourcing. But more importantly, I think where even when we come into the fold and there's already a private equity player at the table and they're not necessarily thrilled to see the bankers show up, one of the things we do here on the back end frequently is, look, we actually think it's probably good they have a banker because we know that it's a young, fast-growing business and they haven't had time to really structure and organize the data in a way that we can consume it very rapidly. And we know that once, having that ability to do that will enable us to have a better underwrite that's more stable. And so there is an element too where just if you're not doing this serially, the likelihood that you've organized the business perfectly for it from just a diligencing standpoint, it happens, but it's unusual. And I think from that standpoint, there is even an appreciation by the buy side of having somebody on the other side that's been through the process helps make that process go smoother, even for the investor and the buyer.
Yep. Yeah, I remember getting pinged by folks that were, on the sponsor side saying, "Are you working with a banker?" And they were all, that was really important to them. I was like, yeah. And they were like let down when I told them we were. And so it was kind of like, yeah,
there's an interesting point we've made in a lot of processes, which is a lot of groups that are very interested and are even maybe potentially submitting or trying to submit bids, ahead of a banker coming in. And situations where we've been around that, and I'd say there's a lot of those situations, a very large, percentage. We've yet to see an example where if it's a sincere buyer, they've left because there's a banker. Now they may not be thrilled, but if it's managed properly and you engage them and you do, there needs to be some level of an extension of courtesy for folks that have been there doing work ahead of time. Now the one up they've had is that they've built a good rapport with the business. We often see them performing very well into or ahead of a process. And if there is preemption, sometimes you'll find that that's what really drove it, was the fact that there was a very good relationship there. And people trust what they're seeing and knowing that, hey, the bankers signaling, they kind of know where the market are. There's an intersection point there, and we like these guys. So why maybe even go and risk the bid in hand? So there are times where it's still to the advantage of the investor or the buyer to be there having conversations, even if the banker comes into play. And I think that's where, I've got lots of friends that sit on the other side of the table. That's where I think spending the time with companies early still pays off, even if there's a banker, candidly.
Mm-hmm.
So one thing I wanted to make sure we talk about, which frankly, I almost feel like at this point in time, we're obligated to talk about in every episode, because we seem to talk about AI and crypto in every episode, come up a little bit in one way, shape, or form. And during our prep call, you had some really interesting perspectives on there about needing to be careful when you're looking at deals and you're examining companies about whether it's legitimately AI or it's something where somebody just slapped AI on a legacy company and they're calling it, "Woo, we're AI now."
Yeah.
What are you seeing in that space? Because I think in both cases, AI and crypto, so very crowded, right? You see a ton of activity there, a lot of movement. So just want to get your take on the space.
Yeah, on my end, we're seeing it most through the lens of AI, just given where our firm historically plays. On the fintech side, we are seeing crypto, but in terms of where we can play it well as an advisor, a lot of that's very asymptotic, right? It's hey, they've gone, it's a Binance that's gone to the moon, or something that's very large, or it's a early stage kind of venture play at the moment. It hasn't kind of hit that growth paradigm that I mentioned earlier, where we kind of found this niche of, it's not quite venture, but it's not, kind of mature buyout land. So in that ecosystem, like what we found is addressable there is still like it's a little bit, kind of binary and not, it's almost barbelled, if you will. And that barbell in the middle is where we tend to advise the most. On the AI side, that's a very different story for us. So we're seeing, two different ways it's being kind of, it's coming really through two different streams for us. One stream is, somebody that built, from the very beginning in the last, 36 months, a platform that's very AI forward, right? It was built with the concept, with a view of, a Google white paper creating what is now large language models. And with that in mind, kind of building a tech stack that's really designed to be able to consume, data in a way that is modernly architected, for large language models, and probably very agnostic across them. So we're seeing those, and those are truly, and there's a tremendous amount of venture capital flowing into those type of solutions everywhere. And I mean, I would say it's almost unusual when you see venture capital not moving towards something in AI or AI, modified. That's still very early. There's, the extremes we all know about, Anthropic or Open. Those guys are IPOing, right? And on $1 trillion valuations on platforms that are 3 to 5 years old. These aren't old businesses. So that's the one extreme, and that's kind of like we see in crypto, right? Where the AI first models are in the early stage of their evolution, and so you're either in a venture land or you're very much in this, you shot the moon and you're going public. That in between is just starting to fill out. Like we're just catching the early wins of guys saying, hey, I'm 5 or 10 or 15 million of ARR. I've been around for 3 years. We can showcase retention and growth and consumption of an AI-based product. Those are still narrow in terms of the opportunities we're seeing there, but we're starting to see it. And I think in the next year to 2 years, that's what we'll probably see start to displace what used to be kind of vertical SaaS in a lot of places. The other thing we're seeing is software, classic software, based providers that are having to adjust and adapt in an age where AI is changing the way we're going to consume, those workflows and the way we do work. And I think that's a very interesting ecosystem because those companies, a lot of them are very developed, some public, very nice private businesses all the way down to, single digit millions of ARR. So a very established marketplace, a lot of them with very great retention stats, with very stable revenue streams currently. And they're having to modify because in public markets, they're seeing the trade that came, with, quote, the SaaS apocalypse. And that brought a lot of situational awareness when you move valuations that much inside of a week. And the private side, same thing. You've got private equity backing those businesses where the private equity funds themselves are watching the public markets and knowing that they've got to retool those businesses so that they can defend the marks and they can continue to have an asset that's got long-term terminal value. That right now, that market is a very interesting market. We have some folks that have very good moats. They've got network effects, they've got embedded payments, they've got hardware that they're tied to, they've got moats because it's some form of compliance. It's not going to move. It's going to move at government speed.
Highly regulated.
Yeah, very regulated. And so like there are places, and they're still growing nicely. They've got great retention trends. These are well-established businesses, and those businesses are trading, really well. Like those assets, not a problem.
Yeah.
It's the ones that don't fall in that category that are really having to retool quite quickly. And so there's a lot of different categories of, quote, what is agentic, what is agentified, what is kind of legacy software and very protected moats, but has time to adjust, and what is legacy software, not a lot of moats, more horizontal in nature, and is having to really retool almost instantaneously. And you're even seeing the public markets. When you look at like Salesforce, for example, where it trades versus some of its peers. So that you're seeing the market really start to delineate it, and the valuations are very step function oriented across each of those buckets. And it's not linear like we might see over the last 8 years of SaaS, where it's say, well, your growth rate's this, your retention's that. With a couple of KPIs, we can plot it within 5 or 10% up or down on the valuation curve. That's much more interpretive now, and there's much bigger steps in between what bucket you fall into all those categories. So It's made it for a banker a very interesting market because you're suddenly getting to use your brain a lot more than just, hey, it's 10 KPIs on a page that the PE guys all call and ask the founders for. It's much more about the industry, the technology stack, the adoption rates. So there's a lot more embedded in it. So for me as a practitioner, it's become very fun. I think for business owners, going through that, especially in the software ecosystem, they're having to really get their head around a lot at once. Some are doing it remarkably well, and others I think are struggling. So it's been an interesting kind of period for the market for sure. And we're still seeing stuff get done, which is a good thing from a banking standpoint and capital flows.
I would not want to be this 10, 15-year-old company right now, SaaS in a vertical, or maybe even horizontal too, come to think of it, is with a lot of legacy software that we built on .NET, or we built, pick something. I mean, some of the newer languages, Python and kind of React, and I would include Angular, but some of the probably don't count, but I'm talking, man, having buy-in from management to go and implement a new strategy around putting AI into that code base and having to rebuild that and then having to refactor on top of that. I mean, you're talking about a major rework.
It's real, and that's what people, I think,
yeah,
miss
we're
a lot
we're
is
not
the
talking about
architecture.
that enough. Like, and that affects valuation. And so, if you have, if I'm a buyer of a company and I'm PE, I'm looking at this company, I want to see a full bought-in strategy. It's like, dude, Jerry Maguire, show me the money. How are you putting AI into your processes today as a young tech, not a young, say 15, 10, 15. How are you doing that? Show me. Where are you? First of all, they'll start on the dev side of the house, and that's probably that's probably the best place to start, frankly. I think the companies today, even if you're 10, 15, 20 years old, if you're not thinking like a startup, like founder from a product standpoint with your product lens on features, enhancements, new products, if you're not thinking like that way, you're left in the dust.
Yeah.
Because
we've sensed a little bit of like a reset
yeah.
with an annuity, right? Like, you're fortunate if you built a good business and people still like the product, which most people aren't immediately just saying, you know what, we've agentified our entire ecosystem, and by the way, we don't need any workflow out there anymore. Like, it may happen over time, but it's not happening overnight. So there's a period of time where a lot of these things that have retention can retool. To Todd's point, though, like when you talk about this system architecture and what you would build an AI first, architecture off of, and what you'd have built, a cloud native multi-tenant solution off of 4 years ago. There's a very different architecture there, and the spend that goes into it and the know-how that goes into it is a very different set. And one of the giveaways, one of the things we've been talking a lot to founders and own businesses, all right, help me understand your R&D spend. And it's not because we're trying to, as bankers, have a view prescriptively that we know more than we don't. But what we can tell you is, like, if you had 10 coders, 2 years ago, and you still have 10 coders today building the next widget or the next, product release or whatever, something is probably likely off there. Because what we've seen as we talk to the best-in-class assets is they've been able to do, 8, 10 times more of that coding than what anybody could have done 2 years ago. And so when you think about that, if you're just developing and doing the exact same as you were 2 years ago, essentially if you had 10 people, you need 1 or 2. And if you've got those 10, then why aren't you releasing at 10x the speed or 8x the speed? And so that's a little bit of a giveaway of like, well, wait a minute. We're adding some agentic endpoints, but are we really modifying how we think both on the dev side? Are we thinking about it in terms of our own tech stack and its scalability and extensibility around data lakes and data warehouses and how people are going to consume? Are you thinking about the evolution of your own pricing model, right? I mean, everybody's talking about Anthropic and how cheap it was and how expensive it is for these organizations as soon as they consume it. And so it's a consumption-based model, and that I think that's where people haven't yet gotten in SaaS land either, and that's going to take time. So all these things have to be readjusted. That's a lot for anybody, to do while they're also running the business that they've built. And I think I think part of the reason we're talking to a lot of folks right now is, look, if you're in that situation and you're really excited about building the thing from an AI-first standpoint, is it more intelligent to potentially look at selling or recapping the business? Where you can go, take the exit and sell a nice asset where somebody else can monetize the customer base and the code set or whatever, and then giving yourself the ability to go back and start from scratch on an AI forward plan, right? And I think that's where I talk to a lot of serial founders. They're thinking a lot like that. I talk to a guy who's 75 or 80. He's just saying, hey, this is another wave. I don't know that I want to deal with it. Let's talk about how do we properly exit.
Yeah.
I'm talking to a guy that's 36 or 42 or 50. They're looking at it and saying, well, I get it. I understand what's changed, but to retool that business while running it's a headache. Like, we might as well get what we can from a valuation standpoint, let others monetize it the last mile, and in the meantime, let's go back, and I've got a great idea that's always been on the back burner. Now I can do it twice as fast.
That's right.
And we're seeing a lot of these serial founders come out, and what they're telling us is when they're building these products, like, we are building stuff that would have taken us a year, we're building it in a month and a half, and we're doing it with, instead of 12 people, we're doing it with 2. So the cool thing about this stuff is, from a business starting standpoint, I think the bootstrap founders are getting a huge boost out of this relative to what they would have had a decade ago.
Right on. I would tag along with that and say, at 6 lock today, we're about 10 to 15% hands on keyboard. That is unreal.
You couldn't have done that.
Yeah. 6 months ago, if somebody had told me that, I'm like, there's no way. I'll put money on that. There's no way. But that's happening today. And the reason is there was an article in the journal about the demand for these Mac Minis as really these kind of mini hub stations that are just being stacked so that you can put these agentic AI bot swarms on there that are programmed and they have specific jobs to do within a code base. So code is written, then a swarm comes in and they're looking for bugs. You have another swarm that comes in and patches up bugs, probably more familiar, middle of the fairway type bugs. You have another group that's coming in looking more esoteric, weird, just stress test it in a different way. Then you have another swarm coming in. Hey, let's load test this thing. Can it scale? I'm telling you, this is happening. If you think about this, think about the umbrella sitting on all of these agentic swarms as like the idea of like, okay, can I have an agentic manager sit on top of this and execute and measure and run its own KPIs and just report to me as a head of engineering? Look, and this runs 24/7. There's no one. These swarms don't have to go to bed at night.
Doesn't complain, doesn't backtalk, doesn't have an opinion.
No, not at all. It's amazing. It's real. It's really happening. It's the first place in business we're seeing. Look, what's happening now is the fact that what used to be the most expensive, elongated, biggest bottleneck in our business has flipped upside down over to this area that it's much less expensive, much faster. But you and I both know, Robert, like with new tools and new solutions and things like that come new problems, right? So we're looking at this going, okay, where's the whack-a-mole going to pop up now? This is great, but what are we?
Yeah, it creates a bottleneck somewhere else.
Yeah,
I think that's why people are saying programming talent's fine.
Yeah.
Is because somebody's going to have to be that human in the loop, to find the next,
That's right.
It's the classic MBA, case studies like, hey, you solve one bottleneck, creates the next.
Yeah.
And like even in our industry, like we're seeing it, right? We can do certain things faster, but then it creates a headache somewhere else. And so I think what it's going to inform is different hiring strategies, but it definitely, the need to be able to articulate all that now is in a process is dramatically important. We 3 years ago I said, hey, within certain KPIs and certain verticals or in certain areas, we can tell you about what the business is worth pretty tightly, and there's going to be X number of bidders because we know them that innately. And, today, what supersedes those questions that those buyers all ask the banker on the other side is, let's talk about kind of where AI defensibility is, where the moats, and going past defensibility, like you can be offensive. Right.
Right.
Right. And the best in class, when we look at some of the upmarket sponsors, even, they're touting the ability to stand into these large enterprise software business and spin up 10 or 15 million of ARR inside of 12 months on an agentic workflow they created and ideated off their deal teams. Now that's a little bit of marketing at times, but I think there's some validity to the idea of that's offense, not defense. And so I think having an ability to say, hey, look, we've thought about this. Who hasn't? Here's where we've got defensibility. Here's what our moats are, and then here's how we're actually winning. Going that last mile and saying, here's what we're winning. That's become hypercritical. Like that's the binary light switch that the KPIs are both hang around and ask, but they don't really care if they can't answer that first question when they go to their investment committee or they go to somebody internally. So that's where we're spending as bankers, as advisors, a ton of time with our clients is. And we all hate it. Like, I mean, everybody's AI. After a while, like, yeah, we get it. It's coming. If you don't notice, you were dead. You weren't here. We had a conference the other day. I bet you 30% of the time, this was 600-700 folks here in New York covering 5 or 6 different industries. It was on AI, and that was not by design. Every conversation found its way there because it's on top of everybody's mind. And so if you ignore it, you're missing the boat. But we are. I would tell you, like that is where our teams have had to spend a lot of time themselves getting re-educated so they can ask the right questions and present the business the right way. But it is amazing how fast the market does get smart. It is interesting to watch some of these private equity guys, what their questions were in January and what they are today. To watch the response from, one of my vice presidents to one of their, principals. It's a dramatic evolution. So there's an interesting thing afoot in that regard, which is this market's repricing and rethinking even in private markets very, very quickly and efficiently, which is as a banker is what you want to see from a clearing function.
Yeah. What's really interesting is you kind of teed up our next little segment here. Like, maybe as a professional, you've done this before. I don't know. So we were talking about, like, and perhaps one of the things that I asked you that I was really interested in was, when's the right time to get out of a business, right? Because you got these exciting areas. AI is being a great example. We saw crypto. We've seen so many, I don't want to call them fads. We've seen moments in the past, right?
Yep.
Where suddenly everybody wants in. And we see a lot of businesses being built. But at some point in time, you have to decide, like, when do I get out? When's the right time to exit here? And I'd love to explore that a little bit, because you were talking about it from a different angle that I didn't anticipate just a few minutes ago about you've built this business, you built it as a SaaS business, and all of a sudden, like, the world has changed, and somebody could build that exact same business that you have with 10% of the people. They can do it faster, they can iterate, they can move quicker than you, and so you'd have to, like, do a complete zero-based budgeting type thing and wipe everything out and start from scratch, or, like you said, sell the business and start something new. So what is the right time? Like, how do you advise people, like, what's the right time to think about exiting?
Yeah, I think maybe starting on that point, and I want to put a fine point on that. Like, I don't think, I would say the world's not on fire, right? Like, there is, for a lot of these businesses, time. So, like, zero-based budget, take it to gross margin and add 2 guys. But maybe there's 1 or 2 subsectors. I would argue that's maybe a good idea. There's a lot of places, there are moats and there's time, but you've got to be moving on it. And I think that the real question is, it goes back to the individual, and this is going to get to the answer to your question, which is that individual, if to them it makes sense, because they say somebody else can monetize a good business, pay me a good multiple, and I can go I've got this pull, I've got this, like, true pull internally to go do this, right? And I think for them the time is now, because they're saying, well, wait a minute, this is a unique moment where money and capital and technology are all flowing together at the same time, and if I want to go do it, really cool. And so but that comes back to the timing of that human being, which I would argue is one part of the equation, which is the time's got to be right for you, whoever you is in that ownership equation, in terms of, is there a certain event in life, a milestone, legacy, estate planning, de-risking because it's your first big hit as a young guy. Like, I can give you lots of, hey, you inherited it, you don't have a clue, and it came from an uncle that had a bad record. I mean, weird things happen, and so there's an element of, like, your timing, right? Like, is it and your needs? Is it all the way out? Is it partially out, or is it capital to grow and some liquidity? A lot of variation. Then there's also the business and the market, and those 3 things are what are going to drive this answer entirely. The business, there's an optimal timing for a lot of businesses. There are scale points that you naturally fall in. You feel them as entrepreneurs. Suddenly, that next effort of growth, it requires either more capital or another partner that understands a different go-to-market strategy, because you want to go through channel and you've been direct, or rewrite a code. It can be a lot of different things. So there's the business, and the business also has growth points, right? Where you've had a really nice trajectory, without a little infusion of capital, continuing that trajectory may be hard, right? You need to come off the tracks for 6 months, 12 months, rehire down, pull that margin down a touch because you need a head of whatever sales or, whatever it might be. And you're already running a bit at the edge of bootstrapped, a slight burn for 5 minutes while you catch your breath and re-accelerate the growth may make a lot of sense, right? So there are times where it's the business. Then there's the market. The market's a harder one from the standpoint of if anyone can procrastinate them, they ought to be a hedge fund manager. We all try and we all think we know. We're usually directionally not far off. Yeah. But I use an analogy, and we may have talked about it in prep, where there's kind of this feeling that, like, how can the party get any better, right? We've all been there. Maybe you were in high school and had to run from the cops at the end. Maybe it was a college fraternity party. I don't know. But we've all been at a party. It may have been one where your wife said the wrong thing at the last minute, and you should have left 5 minutes ago. Or you should have. Yeah. We've all been in those situations where it's just too good, and you should have left an hour or 5 minutes ago. There's a reality to that, and that happens a lot when you cover businesses for 20 years like I have, and we do as a firm. You see it all the time where it's pretty good, and somebody starts playing for that last penny or 2 pennies, and you're like, I don't know, man. You're one of the first to exit, and there's only 10 of you, and once 1 or 2 of you move, the consolidation is going to happen in the last 3 or 4. The pricing power is going to switch to the buyer, right? So some of it depends on market fragmentation. Early in a fragmented market, moving too early could be disadvantaged because it's hard to see who's really winning. As that consolidation takes place and there's less and less folks in it, your timing becomes more and more critical, right? If you've only got three competitors, what they do and what you do have a dramatic impact on each other. So moving first often can be very intelligent if your business is ready to go. If you've got 30, you probably got more time. So some of this is just looking at market consolidation. When we see the consolidation begin, the old Forrester wave or Gartner wave, I forget which one, but it's kind of an interesting thing, right? Where you see this really fast uptake. And at that uptake, what you're seeing is the same in M&A markets. When they're starting that consolidation, people are just placing bets, valuations run up really hard, and then they start to kind of come, and curve off a little bit. And you can start to feel it, right? People in bidding processes can't get past where they were in the prior deal, and you've seen them there. And so if we have assets in the same verticals, which we often do, what we'll see is the first couple are, they keep climbing over each other because somebody saw some other guy invested and they want to get a move, and there's not as many places. And then suddenly you get those same kind of process going, and you feel like it's trying to get past that multiples, like really pushing on a little bit of a string. That tells you something about the nature of the consolidation and where the multiples are, irrespective of macro. That's a fourth variable that none of us can control. And so if you take macro out of the picture, you've got to watch the micro of your industry, your business, and what is right for you. And that's all that's going to control this stuff.
Yeah. Hey, Robert, speak a little bit to the buyers and whether it's strategic or whether it's another sponsor coming in, whether it's a recap or brand new.
Yeah.
There's differences there, right? And there's differences in valuation, reviews on it.
Yeah, I think as you're earlier, in that growth phase, right, you're going to have folks that come from the backside of venture into the side of growth equity. Now that may be a minority or majority capacity, and there's a lot of folks that are swung, to be hybrid, so they can go either way, really to be able to get the advantage of winning the business and the ability to invest from the founders. And so you see those groups, and they tend to be where your highest multiples, live, right? Because they're still anticipating growth. And so that high revenue multiple that you're seeing is nothing more than a signal about future cash flows and future revenue growth that drive those future cash flows.
Right.
As you kind of get to the growth curve and you start to get more consolidation in the industry, or TAM is eating up more, and it's a more mature, industry and ecosystem and business, you start to swing into the world of more of the kind of growth buyout and then into the buyout guys, right? Where those guys that were doing the minority side suddenly don't exist as much. Most of these guys want control. Some might do just a little bit less, some might just do pass control, but they're really, kind of moving from an underwrite that has zero leverage in it, that may allow you to bring down margin, to one that is more about margin optimization and maintenance of growth. And that's where you start to get into that mature business. The multiples tend to be a little bit lower in the growth guys, but the businesses tend to be a little bit bigger and more mature, so you're putting a multiple on a bigger base. So there's this inherent game of, based on where you are on that curve, if you're trying to liquefy secondary proceeds that go to your pocket, where are you and how do you take advantage of that? Are you better off to let the business grow a year or two while the multiple might be down, your base might be bigger? If you can hold the growth rate, the multiple may stay where it is and the base is bigger. So that's the calculus that often is a part that when we talk to the founders, the guys driving these businesses, we ask them, like, hey, look out a year or two. Do you envision being able to hold 80% growth, or is it going to be 40? Is it the fact you're creating 15 million of new sales, but the reality is replicating that and doubling it to 30, because that's what you're going to need to hold that growth rate next year, is tricky, but you can replicate the 15. And that starts to give you a sense of what's the decay rate on the growth. And that starts to give you a little bit of informational timing around, is it now or is it a little bit longer? Is it 6, 12, or 18 months? Usually it's not. It's rare when we talk to folks and like, yeah, I want to hold another 5 years if they're talking about doing something relatively soon. It's usually, is it 6 months to 18 months difference?
So as we get ready to close it out here, I imagine we've got two people in the audience, even though our primary audience is PE, private market professionals. Sure. I imagine there's probably some founders who snuck in here. And they're like, well, this is real. I can nerd out on this stuff and learn everything. And, as a founder myself, who runs a business, you can't help but think occasionally like, oh, how much could I sell this for? Or whatever. Everybody gets that idea in their head. And I'm sure when they start thinking about selling the business, that's one of their key focuses is like, what's the payday going to be? But, you and Todd, in our prep call, talked a little bit about like how important it is to find the right partner, right? That it's not always about the highest price. It's sometimes oftentimes really about finding the right partner to work with. Maybe we can close on that. Like, what do you advise or wish founders knew before they walked in the door, or whatever that is? Like, how do you advise in this concept?
Yeah, sure. I'll jump in. I think as a founder, I think you need to kind of step back and try to understand yourself and your leadership style and capabilities, where your strengths are, where your blind spots are. If you have a co-founder, how has that co-founder complemented you? Because I think that's your story to tell as you decide to go to market and partner with a banker. It is true. I mean, capital can somewhat be commoditized, but finding the partner it elevates everything for you when you do go to market. Again, you want someone who's going to turn the lights on in the room and really show you the path, the direction you want to go. And as you heard from Robert, the variations are completely many, but it really comes down to knowing who you are as a founder and your co-founder together. Who can you work with? Who matches you all and lines up? You need to be aligned on what your goals are, and do they like those goals? Does that fit their strategy? What they normally, is there a fit there on that? I mean, I also think too, just getting to know each other. It does take a little bit of time. Just the founder, you're handing over your baby. You're working together on this thing that you've put a lot of sweat and tears into, and you're going to be, you want that handled gently, and you want full transparency, and you want honest conversations about things that could be better, things that are already great. You have to talk about your organization. I mean, when you go to market, everything's peeled back. The onion gets all the way down to the kernel. And you have to be able to talk about all of those layers, the good, the bad, the things that are not so great, client acquisition, who are you looking for? All of that really comes into play. And look, having a partner that's just really going to be very honest, and as a founder, you need to be a little bit vulnerable too, and just be yeah, your business is not, I've never met a perfect business out there, and there's not one out there. And so you need to be kind of open about that too, and just being open to feedback. You need to be open to criticism. You need to be open to having great conversations about what your goals are too. And that other partners, that partner you're looking for is gonna really kind of mirror a lot of that, right? They're gonna gravitate toward, they're gonna absorb a lot of that, and they're gonna see where you want to go, and it's just finding that match, finding that fit with one another. And look, at the centerpiece of it all is the integrity side of this. Do they line up with you in how you do business? Do they treat others fairly? Are you being honest, really, really honest about the company and where things are going, maybe where they're not going? What is your plan? Have you marched to that plan? Have you hit certain goals? All those things come into play, and it's such an honest conversation, I think. Robert, what do you think?
Yeah, I mean, I think that's pretty spot on. I think it's like anything else. Some of life is what's in front of you, and if you don't have a few options, anything can look good. So I think getting to know at least a few folks, use a bank, don't use a bank, but I would get to meet a few. Some of the guys you meet with are culturally going to resonate very well, and others are going to put you off. The hardest one is when somebody puts you off and they are a good bidder, right? And I've had, not frequently, but I can think of probably a handful of processes over the years where our second place bidder is the winner. And so there is an element when you start dividing a pie and thinking about tax effects and rolling equity, that suddenly what looks like a sticker price of a certain dollar, usually in the millions or tens of millions of dollars, it doesn't look like such a deviation when you waterfall it all the way down to what your net take home is and where the pieces all fall. And suddenly then the culture becomes hypercritical, and the integrity obviously being a key part of that. I would say with that as experience, you generally want to look at there's enough investors out there that have, in a few senses, maybe there's not where people have played before, but most of the time, if you talk to enough investors, somebody's played in or around that ecosystem, and some of them have very good track records. So I think, there's also a track record element of, can you look at what they've done, think about what you are, ask to talk to the other founders of some of those portfolio companies. They'll volunteer them if they're good stories for sure. If they're not, they still probably will. So I think it's doing a little bit of homework. Your banker should do some of that if you have a banker, which is, here's the relevant experiences, who's coming to meet you, likely to be on your board, and those are the guys you want to hone in on. The associate that's peppering you with a lot of questions, you'll be answering that person because they're trying to decode what your business is on their side. But the folks you really need to pay attention to that principal, that guy who's aspiring to be a partner. Pay attention to that partner. Is it a partner that is on the investment committee? Is it a partner that's older and maybe on his way out the door in 2 years? Or is it a brand new partner, right? And there's pros and cons to all that. That brand new partner's got to make it work. That principal that wants to be promoted has got to make it work. And so ask yourself also, like, what are their motivations? Where are they in their own career path? And I think when you start to break that down and you look at track record, and then you bring the social and emotional side of it to bear, I think at that point you start to have a little bit of a bearing. And obviously, if you've got more options, the more of those you'll find that fit closer in all those buckets. If you've only got one option, you've got one option, right? So the idea is always optionality.
Mm-hmm.
Fantastic. It's been awesome.
Yeah, guys. Appreciate it.
So, the website is jl-co.com.
There you go. We kept that short.
And you're active on LinkedIn, so we'll make sure we get those linked up in the show notes. Any place else you want us to send people to get more information about?
No, website and LinkedIn are perfect. I try to keep it simple.
Yeah.
All right. Awesome stuff. Well, it's been fantastic. Thank you very much for coming on the show. I learned a lot. This is amazing. Awesome stuff.
Yeah.
Good stuff.
Thank you, Mike.
Robert, appreciate you, bro.
Todd, good seeing you. Absolutely. All righty. We'll talk to y'all soon.
All right.
Thanks.
Take care.
Bye, guys.
Thank you very much for listening to and or watching this episode of the 6x6 Lock podcast. It's always fantastic to have you with us. Huge props to Robert Koven, who apparently came through Austin recently without inviting me out for beers. So, look, we'll let it slide this time, but thank you for coming on the show, Robert. Really love this conversation. It was awesome stuff. Now, as I mentioned at the top of the show, please do make sure you subscribe to the 6x6 Lock podcast on your preferred podcast platform. And, be nice to each other. We'll see you next time on the 6x6 Lock podcast. See ya. Bye.